What's going on, everyone? My name is Kenneth Beer here with Stock Indices, where I go over everything stock information and investing and everything money. So, in today's video, we're going to be going over iron condors. Now, if you're new to options investing, this may be a little bit advanced for you, so I want you to go back and watch the other videos on how to trade basic put and call credit spreads. Those videos will give you more understanding as to what it is that I'm talking about in this video. But I'm going to teach you guys how to construct the iron condor, when are the best environments when utilizing, what are the best environments to utilize the iron condor, and just some of the things you want to be looking out for. So I'm the person that will always tell you, you always want to have a directional bias when it comes to trading options. You always, even if you're selling options, I know selling options can be, they could be a neutral to bullish or bearish strategy. You know, selling options can almost always be neutral, but you still want to have a biased assumption whether or not you think a stock is going to make an advancement in the future or make a decline. So, with that being said, I still am a big believer in trading iron condors in certain situations, and that's what I'm going to go over soon. So, with that being said, like, comment, and subscribe on this video, and let's hop straight into the charts. So, topic is iron condors. What are iron condors? Iron condors are, it's a delta neutral strategy, right? So how do you make money on an iron condor, right? Okay, you make money on an iron condor when you do a put credit spread and a call credit spread, and the price action at expiration closes in between those two strike prices of the put credit spread and a call credit spread. So I'll make a quick little example for you. This is currently my charting. This is, I use TD Ameritrade. So perfect example right here, because I did a iron condor on this recently, and I'm actually still in my condor. I'll explain to you guys more in depth how that is going and everything like that. So here, what did the market do? Let's do a little recap real quick. What did the market do? So market was uptrending. Boom. We broke our uptrend, came up, hit the, what is that, 200-day SMA, and market started to dump. And we started to dump until we got back under that 38.95-ish area. Now we're just kind of sitting in. I have that marked as a key level. I had it marked as a key level of resistance, support. Broke through support because of the extreme selling pressure. And so as we broke back into that previous range, that support then became resistance up above here. You can see this was previous resistance here, and then here. And if you can see how many times this level was active. Okay, so that is why I had that on my radar. Okay, not only that, and it coincided with the moving averages and everything else, right? So market dumps, we get back below into that previous range, and what do? We try to make an advancement back into the range that we were just in, above that 38.95 area, but we can't do it. We come up here and then we reject. And for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, we go nowhere besides sideways. Okay, that is the type of price action that you want to see when trading iron condors. So, how would you trade an iron condor on this? Okay, same exact principles as if you're going to trade a put credit spread or a call credit spread. If you're going to trade a put credit spread and you think the market is going to go up and you have a bullish assumption, well, what do? Let's use this for example. Not too long ago, I was making money on the upside on this very here price action. I was selling the 3,700 puts, and I was buying, I think, like the 3,650. I usually do about a $10 wide width to collect more premium. And then also if I need to do adjustments, I have wiggle room to do that as well. So I usually do about a $10 width. So, but that's besides the point. So that is the construction of the put credit spread that I had. Now, I'm still holding on to the 3,700 puts. Those are making me money. Now, a couple days ago, 3 days ago, I saw, okay, we are still consolidating sideways. We're not going anywhere. I don't know when the market's going to advance. Why not take advantage of this indecision? I went up to the 390 30s, which is about right here. I sold call credit spreads. What do we have? We now have an iron condor. So if the market stays below 39.30, we're good. If the market stays above 3,700, we're good. So the market has to just stay in between those two strike prices, the 3,700 and the 39.30, for me to make max profit on my iron condor. Now, that's not to say that Theta, also which is our friend as option sellers, will begin to eat away at those premiums. So we don't have to wait essentially all the way into expiration date. We can close it out 5 days before expiration, 4 days before expiration, 10 days before expiration, depending on how long you constructed the spread for. That is the beauty of iron condors. So I initially had a bullish assumption. My bullish assumption was that, okay, we are having trouble going any lower. I saw the choppiness sideways. I said, okay, I'm going to make an assumption that we're not going to go any lower. We're going to stay above 3,700. Did that. Then I saw, okay, we're also having trouble getting back above that previous range. Let me go ahead and sell some calls and collect a little bit more premium. You get way more premium when you trade iron condors. Not only because, yes, it's a delta neutral strategy, but there is that possibility that one side of the trade could be wiped out and you could lose money, right? You may not lose a ton, but you won't make the maximum amount if you had just a call credit spread or just a put credit spread. So I think that is why TD Ameritrade rewards iron condors a little bit more, because they know the risk that comes with it. They know that at any moment the market could go in the favor of the buyers or the sellers, and you may be a buyer, or not a buyer, you may be long, excuse me. It could go in the direction of the bulls and you could be a bear, or it could go in the direction of the bears and you could be a bull. The TD Ameritrade knows this, the market maker knows this, and so they do reward iron condors a little bit better. So if you can be correct on your assumption that I think that it's going to stay in between these two strike prices because the market is in a choppy environment, then you can get paid very well with iron condors. Now, the goal is to be patient. I would say leg into the condor. That is the way I do it. I never look at a stock. I didn't look at this and go, iron condor. I looked at this and said, I think I'm going to be bullish, right? I don't think it's going to go any lower than this. That was my initial assumption. And as time started to progress and I saw the advancement of the SPX still be difficult, I didn't see any advancement. I said, let me go ahead and sell calls. Now today was a triggersome day. I could say that for the call side of the condor. And there is a possibility that I could begin to lose money if this continues to go above my short strike. But you get so much wiggle room that even though, and it's the beauty of it, by having a bias, right? I already have most of the theta in my put credit spread factored in to the put credit spread that it has more value. So when I went in and sold the call credit spread, it has less value. So it's the put credit spread is still protecting the call credit spread. Now they both have the same expiration dates, but you get the gist of it. It's been open. The put credit spreads have been in open position for much longer, and so it has more value, right? Call credit spread up above has less value, but same expiration date, right? So all I have to do is wait. Now, if this begins to go even more against me, let's say I'm really waiting for the spread. You know, I have about 8 days left on this, so I'm gonna wait until the spread begins to go red. I'm holding this currently because, okay, well, there is a possibility that, yeah, we saw a big green day today, but this is a very technical level here that we're facing. There could be a lot of sellers here. So I'm going to see, it's Friday, so we have the weekend, which is even better, more theta taken out of the spread. But we're going to wait. I'm going to wait to see how the market reacts to this level. Now, if we pop this on Monday and we just flush through 39.30, I close the trade, right? I close the spread. And that's that. But in a lot of occasions, this is not just going to go like that. We already know that. There's going to be some sort of resistance. And I just need 8 more days. 8 more days to stay below 39.30, which I believe could very much happen. Not even 8 more days. It could drop again, and I can close it within the next 3 days, 4 days, 5 days, and still have a profit, right? All I'm looking for is 80% per spread. 80% profit per spread, we close the trade. So, with that being said, that is what you want to look for when trading iron condors. I'm going to show you guys really quick before we end the video how to construct. I almost forgot about that. How do you construct the iron condor? So, if you're using TD Ameritrade, which is the best platform I think you should use, this is how you do it. I don't know how you do it on any other platform because I don't use anything else. I use TD Ameritrade. So if you're using Robinhood, you may want to watch a video on how to do it on Robinhood. But if you use TD, this is the place for you because that's what we use over here at Stock Indices. Okay, so let's go about 24 days out. Right. Okay. So let's construct the same trade. I'll get a little bit closer. I'll sell the 37.50s because we have advanced a little bit more. So I'll sell the 37.50s and I'll sell the 39.50s. I think that's pretty good. So we'll go 37.50 right here. We're going to go to sell iron condor. Let's move my big head out the way. And so you can see here when you're looking, if you see my mouse, my cursor, it is showing us that on the call side, we're going to sell the 37.60. Now, I'm going to switch that to 37.50. And, oops, wrong one. I don't know what I'm thinking right now. Okay, I'm at 39.50. So 39.50. And we're going to sell. We're going to buy back. Wrong again. I'm sorry, I'm messing this construction up. We're going to buy the 39.60, 39.50, 37.50. Boom. So 37.50. So on the put side, all right. So look, I just want you guys to pay attention to the short strikes here. So the short strikes, we got the 37.50. We sold the 37.50. And on the call side, we sold the 39.50. 39.50 up here, 37.50. Boom. So in the next 24 days, we got 24 days for it to stay in between this range, right? And we're selling at 21 delta on the put side. And we are selling at the, let's see, 39.50. We're selling at the 41 delta on the call side. So that is, I'm gonna switch that. I gotta go at least to 40.20 because that is a pretty close 40.20. And then I'm gonna do the 40.30. Okay, so here we go. That's more like it. So we're gonna sell. We get a little less credit, but that's better. So we can sell the 40.20. So where's the 40.20 at? 40.20 up all the way up here, right? And all the way down here. Way better. Way better. Okay. So what does that look like? Okay. What does that look like on the Analyze tab? Boom. This is what the Iron Condor looks like. You can see that if we stay above the 37.50, we max out. If we stay above the 40.20, we max out. And this blue line is the intrinsic value, and this purple line is the extrinsic value. Extrinsic value is the value right now. That's the current value of the spread, right? So we open the spread up, you see what happens. And up here, that's the real value, okay? That's the value that at expiration that we're gonna see. So you can see closer to expiration, as we get closer to expiration day, extrinsic value starts to be more realized. And then on expiration day, which is the 30th, right? On the 30th, well, we'll go to 31st. Well, on the 30th, if we're anywhere above here, we pretty much have assumed max gain. And on the 31st, you can see here, max gain is $4,500. Okay. So that is how you construct the Iron Condor. I honestly wish I would have traded that instead, but in certain environments, like I said, you want to be able to look and discern whether or not it is the proper time to construct the Iron Condor. Like I said, always go in with that initial bias that you think a market is going to go in whatever direction. And as time goes on, you can look at it and say, okay, the market isn't going in that direction. It's kind of just chopping sideways. Let me construct an Iron Condor. And that way, you know what I'm saying? It makes more sense. You stay patient. You have more conviction and confirmation that this market is just trending sideways and that the Iron Condor is more likely to be profitable. So, hope you guys enjoyed this video. If you did, leave a like, comment, and subscribe. Put down below some ideas or questions or ideas that you may have that you want me to go over when it comes to options trading. I will go over them. That's what my YouTube channel is about, to help you all, give you guys more information and knowledge as to how to grow small portfolios and how to trade safely while using options. So I'll see you guys in the next one. Thank you for tuning in.